Hello and welcome to another Ascender Academy. It's my pleasure and a great pleasure to introduce Robert Corbally of Horsa Consulting, a friend of the podcast, someone we've interviewed before, but we were talking recently about a couple of issues in the Manco space, so I thought it'd be interesting to get you on again. Robert, for the benefit of our viewers, could you give us a little introduction to Horsa Consulting and what you do?
Thank you, Stuart. Good to see you. And yes, Horsa Consulting, I set up 5 years ago on the back of 20 years in corporate environment, structuring, developing, distributing investment funds. So I'm very familiar with regulated investment structures.
Mm-hmm.
And it was the opportunity to take that capability and expertise and do it on my own terms.
Brilliant. Well, as I said at the beginning, we were talking recently about some of the issues in the Manco space, and there are a lot. I mean, here we are in 2026, very difficult markets, not just with what's going on in Iran or Ukraine or any place like that, but generally the market conditions are very good. So people have got to think long and hard about launching a fund. And I guess our opening question has to be, why would an asset manager look to launch a fund into the European space today?
Core question, of course, and fundamentally that obvious question, as you allude to, I think irrespective of the market environment, that question is always relevant and is always a difficult question. Why launch a fund? And there are so many ways to dig into the detail behind that, but fundamentally, from a market perspective, Europe offers great accessibility to investors on a global basis. There are very well established, well recognized, well regarded regulatory schemes and structures in place to leverage the infrastructure, the distribution infrastructure, the practical infrastructure is in place. And then the other factors are whether, as an asset manager, you have a capability that you think is going to be of interest to certain segments of the market that perhaps you're not able to access currently.
When we're talking about Europe, we're really talking about global products, though, aren't we? But if you're a US manager, you're looking at the rest of the world, excluding the US. In your world, do you include Europe generally and the UK? Is UK part of Europe in that?
Yes, I refer to my world. In my world, I refer to Europe geographically rather than politically or economically.
So you're not a Brexiteer
It
then?
saddens me that we have to make that differentiation now. Yes, that is a real shame, but very much geographically. Look, what would be great would be, as a Brit, and we sit here in London, to say we can launch UK funds and sell them around the world. Not an inaccurate statement per se, but the infrastructure and is challenging. It's a lot more challenging now than it used to be, and Brexit didn't help that. So let's move on. And the reality is that if you want to have a fund that can have a global footprint from a distribution perspective, then launching in Europe gives you that global access.
Well, you just touched on distribution, which obviously is an area that I tend to cover far too much, some would say. But it begs the question, is it around the demand or the capability when it comes to launching a fund? How do you see it?
How do I see it? I see it as a marriage of the two. I think that organizations quite often are led by their capability and perhaps they seek the demand. Mm-hmm. But I do think that the demand, without stating the obvious, the demand is critical, because no matter how strong your capability is, if you haven't got the demand, then you're not going to sell it. So it's definitely a marriage of the two.
I would totally agree with that. And I think what I would always make, go and talk to the market first.
Yeah.
If you've got great product, go and talk to the market first. Establish that demand and then create the product. Don't do the fund launch and then go looking for the assets.
Exactly. Clearly, great product helps with distribution because it makes the conversations much easier. If you have an existing capability that's got strong numbers, particularly if it's run in a structure that You've got audited, verified numbers you can use with professional investors for due diligence.
Mm-hmm.
It really helps enormously, of course. You have a much stronger position to have a good product to go and talk to the market. But if it's a good product in a space that the market is not interested in, then
Doesn't
you're on a
matter.
hiding to nothing. Yep.
Yeah, exactly. Let's dig down into some more detail around about the structuring of products, because a lot of fund managers, international fund managers, sit there in New York or Tokyo or wherever they may be, and there's a plethora of sort of structures out there. Can we sort of expand a little bit about on those and what people should be looking at? I mean, what are the options they've got right now? Hopefully, we're going to move towards what Ascender does, but there are other options out there.
Yes. Yes. Well, Ascender covers a lot of the options, I believe, but if you distill it, when you distill it down at a high level, the options are very simplistically regulated or unregulated.
Mm-hmm.
Most for greatest penetration into global markets, regulated is going to be advantageous, because when you're launching and working with unregulated structures, you are limiting the opportunity set from a distribution perspective, because they have to be more experienced investors and the due diligence and so forth. That's not to say there's not a space for that. There is. But that's question number one. And then when you look at, okay, great, we want to operate in the regulated space, then it's whether you fit in essentially the lowest common denominator. Well, the starting point is to look at the UCITS framework, which is a very well-established framework, of course. You're intimately familiar with it. And that covers all spaces and ultimately is a retail-friendly environment. And if your capability fits within that framework, there's normally not really a good reason not to use it. But if your capability is a little more funky, uses some instrument types or some exposures, or from a tax perspective, there's a justification to have something a little more flexible, then we're looking at AIFMD, the Alternative Investment Fund Managers Directive. So those are the two, which is, as the name suggests, more for alternatives when you're taking different exposures. And those are the two options. So if you can fit in the lowest common denominator, then that's great, because it will give you the greatest scope. If you can't or you don't need to, then you can have the eighth.
Okay. I'm going to go slightly off piste here and
I'm happy with that.
Throw a bit of a curveball. Ireland or Luxembourg? Because both do UCITS, both do AFMD.
Yes. Well, so good question. The Guinness in Ireland is better than in Luxembourg, I suggest. But the
wine's better in Luxembourg.
The wine's perhaps better in Luxembourg than in Ireland. There is an arbitrage between the two, but the arbitrage between the two, I think, is very subtle and very nuanced, based on individual circumstances of managers and operators. I would say at a top level, there's broadly no particular differentiation, and you should look at both. Now, where it gets interesting is there are certain segments of these underlying markets, or these underlying regulations, that each domicile has started to create a bit more of a stamp, a bit more of a recognition for. And that sometimes is for good reason. Sometimes it's purely they're the one that have got there first, and that's where the assets have gone. So if we think about ETFs, for example, Ireland has stolen the march on Luxembourg. Yep. That doesn't mean that you can't launch an ETF out of Luxembourg. They do have ETFs.
They do have that, yeah.
But it may be that you don't, as an asset manager issuing an ETF out of Europe, you might not want to have the conversation explaining, oh yes, my Luxembourg ETF is just as eligible as an Irish ETF. That could be a consideration. They had the same thing with cash funds back in the day. They had the same thing with the LDI capabilities. Going in to pitch your LDI, your liability-driven investment strength as an organization, if you weren't based in Ireland, the first half of the pitch was explaining why your Luxembourg structure was just as good as the Irish structure that all the big players were already using. So there's an element of that's a nuance, it's a soft nuance, but it's really relevant in practical terms of distribution. On the alt side, Luxembourg have generally been a bit stronger on the alt side, and they've been more nimble at managing structures that support different capabilities that have perhaps more complex tax requirements. And Luxembourg have been better at doing that. Ireland have been trying to catch up. But at face value, a lot of they might not like me saying this, or equally they might think it's the best sales pitch ever, but a lot of the service providers, perhaps even Ascender, are in this same category, are broadly agnostic. They operate in both environments, and particularly with the admins and custody, it's a follow the sun model. A lot of it's very, it's all based from core service centers. So the jurisdiction comes down to an element of obviously looking at the structuring and seeing if there are any specific nuances that are relevant, but also preference.
Yep. Personal taste.
Personal taste. Yep.
Okay. Let's look at the other aspect of decision making, which needs to be made, and that's when fund managers launch a product. Should they do it as a standalone under their own umbrella, or go onto a platform?
How long have we got?
It's a big question.
Yes.
I think I know the answer, because I think it's, well, my spin on this would be about how much time and money you've got, how much capability you've got, how long you're going to give it, and also the costs.
Yes. Both options are very accessible. So cost, time, speed to market, there's a huge advantage to leveraging someone else's platform. That is, there's no doubt about that. You can plug into, but it's also not that sort of top level, not those obvious points. There are also underlying benefits that you don't see. The time spent undertaking due diligence on the service providers, because it's an existing platform, it has existing infrastructure in place to support reporting, distribution agreements, and all of the various ancillary and frankly distribution critical activities that take place, and operationally critical facilities that take place. We've mentioned the cost benefit of sharing with others, of course. The counter is that you don't have ownership of those, of any of those. It has shared ownership. And so if you feel, actually, we don't want to work with such and such service provider, or we want to do something a bit different, you are going through, you feel as if you don't, you may, as an organization that's using it, you may feel as if you don't have quite as much agency of your capabilities as perhaps you might be used to in your domestic market. Now, I would argue that when you set up a regulated fund, the agency you have is the same irrespective of the structure, because ultimately it is the fund that is responsible for itself. It is its own corporate entity, and there's a board of directors that have responsibility. The trustee and depository have the fiduciary oversight, but from that doesn't always fully counter the feeling that some organizations have of I want my own thing with my own name. So setting up your own umbrella, your own fund, your own platform, your own umbrella does give you full ownership, and it means that when you issue your materials and when you talk about your product, you're saying, this is my fund from my enterprise, rather than my fund as supported by a manco. But I don't think that argument, I don't think it makes a difference between selling or not selling. So it comes down again to the preference of an organization and how much personalization they really want.
Let's talk about some of the key elements around the fund itself. The delegates, the people who are responsible for actually making sure things happen. Should we go through them?
Yes. Yes.
So who do you believe are the key elements, the key delegates around the structuring and supporting of a fund?
the starting point is the fund has a board of directors. We've mentioned those that position. They have oversight and responsibility. The fund delegates ultimately because the fund is a virtual entity. It delegates parties to perform all of the functions that it needs to undertake. So the first delegation will be to the ManCo, the management company, and that provides the oversight across all of the other functions that are taking place. The main functions that the fund needs to operate: investment management, critical. Without that, what's your proposition? Clearly. Fund administration and transfer agent. So the fund administration is looking at counting the investment side, and the transfer agent is dealing with the shareholder client side. Then we have the depository, custodian, trustee, all terminology that covers actually slightly different things. So the depository looking after the assets in the fund, the custodian, and the trustee has responsibility on behalf of the shareholders, making sure the fiduciary responsibilities are carried out. So those are the critical admin functions. Fund counsel, the law firm providing oversight, keeping the fund within regulations and managing the key documents there. And then we move into distribution. So a fund will need to have a global distributor appointed. They may choose to appoint sub-distributors depending on the distribution plan and structure, but distribution. And then there are some sort of some other, so as important but less day-to-day business. So company secretary, keep track of the board meetings, and the auditors to count up.
You have to have an accountant
on an annual basis, but absolutely.
Yeah, exactly. Okay. Let's talk now about the decision when it comes to choosing a ManCo. The management company is a big decision for any fund manager to go with. What are the key questions that you feel a fund manager should be asking a ManCo when it comes to taking on board their fund and launching a fund for them?
Is this where I say, why not a sender?
That would be useful. Yes, thank you. I've got the brown envelope. Yeah. No,
the key questions. The ManCo is a central appointment, it's a central engagement. As I've already said, it has oversight of so many critical functions that it really is a very important relationship. The time and care needs to be taken to assess whether that relationship is going to work on a corporate basis and frankly on a personal basis with the personalities involved between the asset manager and the ManCo. So call me old-fashioned, but you should get around and speak to lots of them and meet them in person and not just sort of receive a pitch deck and a quick Zoom thing and then scuttle off and look at the numbers. So having the conversation, key questions to look at: your point about jurisdiction, that needs to be asked, validating the regulatory environment or the choice of regulations, UCITS or an AIFM, based on the capabilities that, not only the capabilities that the asset manager has and is looking to bring to market now, but also potentially the capabilities they might bring going forwards. If, as an asset manager, you have a depth of capabilities that you might look to bring in a few years' time, then you will want to future-proof and make sure that your ManCo could if you launch as a UCITS now, you could potentially add an AIF, and the ManCo's got the permissions. So having those conversations would be, up front will help time. I think understanding how practically the ManCo will support the asset manager to navigate doing business in this new space is really important, because it's not the responsibility of the management company, I would say. It is, an asset manager is a corporate entity, and it's a grown-up entity, and they take the business decisions, and frankly, whether it works and the profitability all come down to them having a product that works and performs and is distributed. But it's a new space, potentially a new space, and if it works for one, it works for everyone. So I think that without abusing the generosity of the mancos. I think understanding the additional support and insights they can offer as to how the market works is really important too. They're not there to provide, they're not there to perform those functions, they're there to perform very strict, rigid, regulated functions.
Yeah.
But there's a softer edge around practically understanding the nuances of the European market and or the opportunities of using a European product to distribute globally. So I think that working with a Manco that can provide that broader, softer support is helpful as well.
Music to my ears, as you know, it's something we talk about a lot internally at Ascender, is that it's when we appoint a fund manager as a delegate to the fund, they have two jobs in my view. One is to run the fund in a compliant manner as per the regulations, yes. And two, dictate the distribution strategy. That doesn't mean that they basically go off and do that distribution strategy, other than employing, obviously, having a sales team to do it, either directly or indirectly through third-party marketing. But then I will sit down with a fund manager and say, well, where do you want to sell it? How are you selling it? And what's the price you're going to do that? And so that consultancy approach to distribution, I think, is key. And it's often underestimated how important it is. We strenuously discuss with fund managers exactly what's your distribution strategy. Hopefully, the fund manager will take care of itself.
Yes, I think it's key. It's a core part of the service proposition that I offer is to help asset managers understand the right questions to ask and help. And there's an element, there's potentially a bit of a conflict, I think, of getting too close to some of the commercials. Obviously, the Manco is deeply embedded in the commercials, but the fund manager as the sponsor and as the, dare I say it, the intellectual capital behind the reason of the product existing, it's up to them to make the ultimate decisions of here's what we have, here's how we price it, here's how we want to sell it, and they need to make it work. But I think getting that right is a lot more challenging than a lot of organizations realize, and they would do well from seeking counsel from a lot of parties, and the Manco as well as other parties, because of the importance of getting it right.
Let's drill down to actually where this conversation really started a few weeks ago when we met up, which is, I guess, the frustration when you're dealing as a fund manager, you're dealing with lots of different Mancos, and you're sitting there on your desk and you've got all the propositions in front of you. One's an apple, one's a pear, one's an orange, one's a real lemon, and you've got a real banana on the curveball at the end of the banana. Everything looks different. What should a fund manager be looking at? How can they consolidate their thought process when they're looking at all those propositions? What experience do you have in this space?
It's an area which takes quite a lot of time, and where paying attention to the detail really pays off. Because, to your point, as with so many things, this isn't specific to this sector, but when you go and ask multiple organizations for a quote, you get what they offer on their terms, on their basis. And so you're trying to distill that through your own internal lens and get a view on a consistent basis. So how would I approach it, or how do I approach it? A starting point, I think a practical starting point, is I would take the most granular breakdown of fees and use that to build out your own granular breakdown of services and fees. So if you have one provider says, we'll do everything and it will cost X, and another says, here's everything we'll do and here's what it costs, you're going to use the one where they've given you the list to then go back to that first one and say, you having looked at the list, do you provide this function, and where's that included, and what does that mean? So trying to build, and as you go through that exercise with multiple participants, you'll build a longer list than the existing longer list that you already have. and that will enable you to really drill in and understand the services that are being offered. And then you need to take the time to, frankly, understand those services and identify whether they're necessary. And that's going to be a combination of seeking your own counsel from within the organization, or people. There may be consultants out there that do that, provide input to that kind of thing, and then also going back to the mancos. Now, you should definitely go back to the mancos, but I wouldn't go there as the first port of call, because they're trying to sell their services, so they're always going to. I'm not saying they're going to missell, but they're always going to be positive about the fact, here's what we do, and here's why it's in there. And I think having the second opinion, so that you can go back with an informed question back to the manco, makes it a much more valuable conversation.
Everything you just said makes perfect sense. The challenge I find when comparing the different proposals is that it's almost like you don't know what you don't know.
Yes.
And invariably, what I've seen certainly over the last 20 years in this side of the industry is that a lot of mancos aren't fully, I would say, don't disclose everything, and often too late do you find out, where it may be distribution agreements, it may be platform agreements, whatever it may be. So I think it's really important that they come and talk to people like you and say, you're missing this question.
Yes.
What's the answer to this? And sometimes it only may be 50 euros here and 100 euros there, but over time,
it adds up.
It suddenly adds up, and your expense ratio goes through the
roof. That's very true. And the other element where I've seen that can suddenly kick in a little harder, perhaps, than asset managers were expecting, is frankly beyond the beyond the excitement of the first dates and the wedding, of getting going and getting launched. And then all of a sudden you're into married life, your fund is live, and you're getting bills through to the fund for various other activities that the asset manager going, hang on a minute, do we need this? What's this reporting going on over here? And what's that? Well, yes, that was, if you'll notice on page 12, section, clause 80, subsection C, you'll see that we need to do this because it's a regulated fund. So I'm not saying that any of the work is not needed, but to your point, fully flushing out everything that takes place and understanding it is detailed, and it can get, when you're live, you've got no option, you've got to do it. And if you didn't realize that was going to happen, it can change your expense ratio, and that's problematic.
And that leads to almost the beginning of this conversation, which was making and understanding the distribution strategy clear to everyone you deal with. If you suddenly say, well, we're only going to do it with the UK, okay, and that is what you want to do, fine. But if the manco is expecting you only be in the UK, it will format accordingly. You've got to go out there, even in the UCITS, which is global products, you need to make sure that the manco knows where you're going, not just today or tomorrow, but 3, 4, 5 years down the line.
Yes. What's your plan? And a realistic, as ever with these things, a realistic plan. You can't gobble the whole world in one mouthful. Taking steps, getting up and running, and building a plan. And obviously the great thing about a plan is that you try and hit it, but quite often you adapt as you go along. But the absence of a plan, and then running into trouble because you've tried to bite off more than you can chew, or it's not going as well as you thought because actually we should have targeted that market, and it's going to take us longer to get into that market, open up access to that market than we anticipated, and we hadn't run through the opportunity cost or the practical cost of doing that. Oops, that's changed our bottom line. So yes, having the plan is critical. A business, stating the obvious, a business plan is critical. It's a business and it needs a plan.
Let's just finish off with probably my favorite area, which is the pitfalls. When it comes to launching a fund, I look at it from again, where my distribution hat, I go, well, no point trying to sell snow to the Eskimos or sell an oil and gas fund to the Norwegians, the ESG and etc. Where do you see the pitfalls when it comes to fund managers choosing mancos, choosing structures for those mancos?
key pitfalls fundamentally are you using the right regulatory environment? So and then on the back of that, so potentially if you set up an AIF when it could be a UCITS, then you will limit the target market, even if you think, oh, the flexibility might be useful to us in future. So getting that right is important. From the Manco and the service provider perspective, I think a potential pitfall is the assumption that because it's a commodity, you can switch it and replace it easily. And that's true. It is a commodity and you can switch and replace. But I would caveat that easily, because even if you factor in that it's a good business decision, the disruption and the resource that it will take is not insignificant. So it's not a decision to be taken lightly. So therefore, that really it places huge importance on looking to get it right first time. Because why wouldn't you? Clearly, if you don't, that's fine. You're not completely stuck, but you want to get it as right as you can. So working with providers that can support the way you operate. This comes back to another point, which I think is meeting in person and understanding the synergies. There are the practical synergies of if you have a super complex strategy that operates in certain instrument types, you may need a fund administrator that has specific skill set to support those instrument types. It may be that, presumably your existing fund administrator will be able to do that if you already run the strategy elsewhere, and they may well be able to support a fund over here. And so you can leverage that. That's one example, but there are also the softer examples on the distribution side. If you're working with a firm that only operates in the UK, but you've got global expansion in mind, then how aligned might they, can you truly expect them to be philosophically and practically around your expansion distribution? So I think that alignment, making sure you have the alignment based on your ambition, and of course your ambition is allowed to change, but you have a starting point of what your ambition is. And so alignment there is really important. And the final point, well, I'm sure there are plenty of more, but the final point I'll make is that costs and expenses run away very, very rapidly if you're not careful. And so being really, really controlled and precise about what's necessary. Must I have it? Is it adding value? And keeping a lid and keeping control on those is really important, particularly in the early days when you're in the build-out phase, because once it sets the right precedent. It's too easy to look at the big funds and go, oh, they've got an advantage. They're so big that their expense ratio is hugely diluted and much lower. But by getting it right from the start, you will do the right thing for the fund, which works, funnily enough, from a fiduciary perspective. It delivers better returns for the investors, and it works commercially too, because you can take your fair payment out of the structure, out of a successful structure. So keeping an eye on the expenses from the off is super critical.
Robert, thank you for your time today. Really appreciate it. Look forward to speaking to you soon, the next Ascender Academy. But for now, thank you very much.